Good evening, ladies and gentlemen. We welcome you again to another episode of GPL Capital's webinar in association with Mirae Asset Investment Managers India Private Limited. Our topics for today's episode is ETF, a way to invest in the index. As you all can see on your screen, there must be a small poll. Request you to please give your answers before we start with our session today. Thank you, everyone. So our speaker for today is Mr. Siddharth Srivastava and our moderator for today is Mr. Pushkaraj Kanetkar. Pleasure to have you, sir. Our speaker, Mr. Siddharth, is the head of ETF products at Mirae Asset and has a professional experience of more than 10 years. He is associated with Mirae since October 2018 and he looks after the passive investment products. Thank you for giving us your valuable time, sir.
Thank you.
Our moderator for today is Mr. Pushkaraj, VP Equities at GPL Capital. He has over more than 15 years of experience in the field of Indian equities. Thank you for joining us today, sir. Now we will start with Mr. Srivastava, who will talk about the ETF, a way to invest in the index, followed by an interactive session by our moderator, Mr. Kanetkar. This time, guests on Zoom can raise your hands, and after unmuting yourself, you all can ask the questions directly to our speaker and our moderator as well. Also, please note questions pertaining to the class will be catered to. Also, we are live on Facebook right now. Link and share our page to your friends and they can view us on Facebook Live too. We are putting up the link of the Facebook in our chat room here. Also, please put in your questions and comments and we'll try the best to accommodate those. I now hand it over to Mr. Srivastava.
Thank you, Forum, for that introduction. So, thank you everyone for joining us on a Friday evening. It's always interesting to talk about ETF. It has getting a lot of traction in India also now after being such a popular investment product in last 30 years globally. So I'll start with the presentation. So disruption in any industry is predominantly caused by two factors. One is product. So product can basically reduce your inconvenience or address your need or desires, or price. So any disruption predominantly is caused by a combination of products and price, or individually either product or price. And ETFs have done that. They are addressing a major convenience factor of customers and doing it at a very low cost. Think of ETF as an Uber, right? Uber gives you a ride, takes you from a point A to point B, and does it at a very low cost compared to owning a vehicle itself. And this particular phenomena, the ETF, has seen a tremendous adoption rate globally. I'm like, if you compare it with social media, e-commerce sales in US, its adoption rate is higher than that. It's just below the smartphones. And ETF industry itself is just 30 years old. So what does globally ETF industry look like? I'm like, we are saying that it has caused a major disruption. ETF industry was basically started in early 1990s when first ETF was launched in Canada, and in 2003 the first ETF was launched in US on S&P 500. It's the largest ETF right now, having an AUM of almost $280 billion, right? The first 20 years till 2010, the AUM of ETF industry globally reached $1 trillion. That's a huge amount for any industry to start with. But in the next 9 years, the growth which we have seen globally is just phenomenal. Next 9 years added $5 trillion. So right now, the ETF industry AUM globally stands at $6 trillion. Just imagine it's twice the size of India's GDP. And it is being forecasted that in next 4 years, by 2023, the ETF AUM will stand at almost $12 trillion, which is double the size of today. So now, since we have given so many numbers here and talked about that ETF has caused such a big disruption, in fact, no other product in an investment industry in recent memory has caused such a huge disruption, right? So what has caused it? Now let's get to the basics of ETF. So ETF is essentially a mutual fund, by Construct, but it also combines the very best of stocks. So, in a very simple language, it's a mutual fund which trades like a stock. But then what it does differently if I compare it to let's say a mutual fund, uh, how is ETF different? One major factor which makes ETF different from a normal active mutual fund is that ETF tries to give you a performance which is equivalent to the underlying benchmark. So for example, a Nifty 50 ETF will try to mirror the performance of Nifty 50 index, including the dividends. This is unlike active mutual funds, which tries to outperform the benchmark, and in that race, they may actually underperform also. So that's the one major factor which differentiates ETF and mutual funds, that one tries to mirror the underlying benchmark performance and the other tries to outperform it and hence may underperform also. Another difference is obviously, as I mentioned earlier, that it combines the characteristic of stock, so it trades on a stock exchange also. So unlike a mutual fund, if you buy a mutual fund today, you'll get a day end NAV, right? But in case of ETF, you can buy intraday and get an intraday NAV. So for example, if yesterday the closing NAV of ETF was rupees 100 and today by 11 o'clock market is down by 2%, you'll be able to buy a Nifty 50 ETF at rupees 98 at 12 o'clock because it tracks the real time movement of the underlying index. The portfolio is more transparent. In case of mutual funds, you typically get to know at the month end basis what the fund manager has invested into. In case of ETF, you know it all the time on a daily basis, because since ETF is replicating the index, the main property of an index is that the method is known, the methodology is known, and hence the portfolio is also known. So customer knows what sort of risk exposure he is getting into and what sort of stocks he is basically holding in case of an ETF. So how ETF does it? How ETF basically mirrors the performance of the underlying index. So I've just taken an example of Nifty 50, a similar index. So let's say an index consists of HDFC, Reliance, TCS, and Infosys. It's the current stock holding. What ETF exchange traded fund will do, it will also buy all the stocks which are there in the index in the exact same weights. So if HDFC was 10% in index, it will buy 10% of HDFC from its corpus. If Reliance was 9%, it will buy 9% of Reliance. By doing so, it creates a creation unit, or what we can call it, a replicable portfolio of the underlying index, right? So for example, let's say it takes around 50 lakh rupees to create the replicable unit of Nifty 50. You have to buy all the 50 stocks in the same proportion. Now this portfolio is subdivided into smaller ETF units, and these are the units which are traded on the exchange. So for example, in our case, in case of Mirae Asset Nifty 50 and similar with other AMCs also, a 50 lakh rupees of portfolio typically is divided into 50,000 units. So each unit is available for around rupees 100, and you can transact based on in a single unit on the exchange. Also, what you can do, and typically what institutional investors do, is they can transact directly with the AMC, but in that case, you have to buy the entire replicable portfolio, which is the creation unit, which is, let's say, in our case, is 50,000 units or multiple of that. Or if you are want to transact on the exchange, you can directly go on the exchange and buy a single unit of just 1 unit, 2 units, or whatever amount you want to basically acquire or sell. Now, one major sorts of myth is in India actually is that ETF is a very simple product. People refer it to as passive products, but actually ETF has a lot of active thinking behind it, right? In India, we are just starting. There are just 88 products in India, exchange traded funds in India, but globally there are 7,100 products on which are ETFs, and they are based on variety of things. It is ETF can be based on a MCAP segment. It can track large cap, mid cap, small cap. It can be based on commodity. like gold. It can be based on a sector like IT or bank. It can be based on a strategy, like let's say low volatility. You want to track a portfolio which consists of stocks which are very less volatile in nature. It can track that. It can be based on a foreign market, let's say Nasdaq 100 ETF or S&P 500 ETF. It can be based on currency, a theme, let's say ESG or a Sharia or even a Jain based investing. So if you can define a strategy, define a method, and a method can be a portfolio can be created, there can be an ETF on it. And that is why ETF industry has grown so much, because you can provide a very focused exposure. So one of the products which our sister company did in Canada was a marijuana ETF. So they basically created an index which tracks the companies which are into legal marijuana medicinal product creation, and that product in its NFO got $1 billion, because that industry was opening up in Canada and US, and people had high expectations on the kind of sales or revenue or growth which those companies can see, and people took a very focused exposure in that. One of the products which our company has is based on electric vehicles. It's based on artificial intelligence and robotics, because they are the upcoming investments, upcoming themes. So people want to take exposure in that. So all these very focused exposures can be created by provided by ETF, and that is why they are growing so much globally. So product-wise, we have now understood how ETFs are created, what are types of ETF. So what are the advantages of ETF, which is making it so popular globally? See, one of the major reasons is twofolds, in fact, threefolds. First is, in any efficient segment of the market or in any efficient market, our fund managers find it extremely hard to outperform the benchmark index on a regular basis. This happened in US when fund managers found it extremely difficult to outperform Nasdaq 100 or S&P 500 on a consistent basis. It has started to happen in India, where fund managers are finding it extremely difficult. The large cap fund managers actually find it extremely difficult to outperform Nifty 50, right? Because the markets are so efficient. When this happens, the popularity of ETF grows, because in case of ETF, no active management is involved. There's no fund manager, there's no investment team. So the cost of ETF is very low. A Nifty 50 ETF on an average is available for just 8 basis point, compared to an active mutual fund whose regular plan is around 2.2%, right? So you are getting, in terms of returns, you are getting hit by less than 2.1% in terms of returns you are getting. So when people realize that market has become efficient, fund managers cannot outperform consistently, they prefer to take exposure via ETF because it is of lower cost. Second important thing, obviously, is that you get to have a very focused and transparent exposure to any theme, any strategy, any sector you want. It reduces the active risk, non-market risk, because you are not exposed to any fund manager. A fund manager can be a value-oriented, a growth-oriented, and based on his philosophy, his funds will sometimes outperform, sometimes underperform. You are basically removing that risk from your portfolio. Also, one important thing is liquidity, and which I will cover later also, that you can transact it at a real-time NAV, unlike mutual funds where you can only get it at a day-end NAV. You can basically buy ETFs based on the intraday price movement of the underlying index. So how do you buy ETFs? I mean, like that is more relevant, and that is one question we get a lot. One is, obviously, you can go on the stock exchange and buy it. Buying ETF is similar to buying a stock. You simply search it by ticker or name or ISIN or any other symbol. As soon as the name pops up, you can buy one, two, or whatever amount of units you like, depending on the liquidity of the ETF. The settlement is also similar to stocks, and it reflects in your demat account just like stocks. So it basically is essentially how you do stock trading. You can do ETF trading. One more way, and this is typically followed by the institutional investors or a large investors, is, as I mentioned earlier, that you can come directly to the AMC and buy a larger quantum directly from the AMC. So in, let's say in case of Nifty 50, in our case, that larger quantum is 50,000 units. So if you want to buy 50,000 units or a multiple of it, you can come directly to the AMC, fill a form, transfer the money to us. We'll create the ETF units for you, credit in your demat account, and that is how you will hold the ETF in your portfolio. So both ways are in a way very simple. I think transacting on the exchange is much simpler, much more convenient, and the quantum required is very less. 1 unit of ETF can be as low as 20 rupees. So you can invest at a very minuscule level also. So I think exchange trading is much more convenient. Then you have an option of coming directly to the AMC also if you want to buy a very large quantum. Now, why are we talking about ETFs, right? GPL Capital wants to not talk about stocks or mutual funds, but want to talk about ETF. There must be some reason behind it, right? We talked about globally, it's not now a $6 trillion industry, but what is happening in India? In India right now, ETF industry stands at 1.86 lakh crores, right? In last 3 years, it has seen a phenomenal growth. It has grown by 46% annually in last 3 years itself. And just look at the equity ETF AUM to equity mutual fund AUM ratio, which has moved. In December 2014, it was just 4%. Now it is almost 24%. So the kind of traction which we are seeing in India right now, it's phenomenal, and there are several reasons which has driven this growth, and it's very right to accept that one of the major drivers has been government itself, which has been using ETF to disinvest its holding through CPSC ETFs and also APFO. You might be surprised to know, if you don't already know, that if you have an account in PF, actually almost 15% of incremental corpus is investing in Nifty 50 and Sensex ETF. So even if you are not directly investing in ETF right now, I think it's good that you start tracking ETF, because some part of your retirement corpus or saving corpus, 15% of it at least, is going into ETFs. So I think this is something which you should, at least if not invest, then at least should be very aware about. And also, as I mentioned earlier, low cost and outperformance of large cap funds by these very simple plain vanilla products. And I think I'll just put in a slide where I'll emphasize this more. So what we have done is we have compared the returns of Nifty 50 and Next 50 ETF with large cap mutual funds. So what is Nifty 50? Nifty 50, I think everyone knows, it tracks the top 50 large cap stocks listed on NSE, and Nifty Next 50 tracks the next 50 large cap stocks listed on NSE. So in aggregate, both represents the large cap space of the Indian equity market. So we have just compared it with the 28 large cap mutual funds which are there in the market. And what we have seen is very stark, right? Just look at 3 years period and 5 years period. In 3 year period, Nifty 50 ETF has outperformed 93% of mutual funds by a margin of 2.4%. In 5 year period, it has outperformed 81% of large cap mutual funds by a margin of 1%. And this is a CAGR, not absolute. Nifty Next 50, just look at 5, 7, and 10-year performance. It has outperformed 88, almost 90% of mutual funds in 5 year and 7 year period by a margin of 2.1% and 2.6%, right? And this is what has basically created a fire, and people are now interested more about ETFs, right? I'm like, returns bolta hai, right? And that is so true that now, since we are seeing in last 2 years especially, that mutual funds are struggling to outperform a simple plain vanilla Nifty 50 ETF, people have started to take more and more cognizance of the fact that there's a new type of fund which exists in the market, which you can buy very easily like stock and get a very decent return, and added to the fact that the cost is so less, right? In case of Mirae asset, Nifty 50 ETF cost is just 7 basis point 0.07%. A Nifty 50 ETF is available for 14 basis points, 0.14%, which if you compare with a large cap fund TER, it's very minuscule. So now investors thinking, yeah, I'm getting similar, very decent return at such a low cost. Why not invest in ETF? And that is why conversations are happening so much around ETF. Also, one very important thing which I would like to highlight here is that one question which one rather reply which we get here is that okay, uh, mutual funds are ETFs are outperformed 81% of mutual funds. I will pick out that 20% which are outperforming the benchmark and invest in that, right? So just do one thing, just pick out the list of mutual funds who are doing well now, who are doing well 3 years back, and who are doing well 5 years back, and just see the names. The kind of turnover, the churn you will see in the list of the mutual funds which are outperforming the benchmark will surprise you, right? आज किसी का दिन है, कल किसी और का दिन रहेगा, उसके बाद किसी और का दिन आएगा, right? It's in that way. I'm like, it's difficult to predict if you're investing in a mutual fund which is performing very well right now, whether that performance will continue. And let's be realistic, right? It's not a fund manager's fault. It's basically everyone's style, and each style delivers a different performance in a different market cycle. So that is why typically if you want to take a market exposure, a beta exposure, invest in ETFs and just avoid that active risk. So in India, what is the market share of ETFs? So just mention that market stands at 1.86 lakh crores, which is significant. Just look at the numbers which is clocking in Nifty 50 Sensex. It's Nifty 50 alone is almost 91,000 crores, right? It's almost 48% of the market. Sensex is at 35,000 crores. Then comes CPSE. I was mentioning that government is using it for disinvestment. Then come banks, PSU bond, which is Bharat, which is by Edelweiss. Then come gold, liquid, next 50. In thematic, there's a Nasdaq ETF, Sharia ETF, infrastructure, dividend opportunities, mid cap. Then there's a couple of smart beta ETFs also, which people have come out with around low volatility, quality, and value is also actually value gave a very good performance earlier. It is not that case now. And then IT also. So point being, in India also the product basket is still very small, but I think in terms of being market ready, it is still a market ready because people still are investing in those plain vanilla ETFs, as you can see, Nifty 50, Sensex, CPSE, banks and all. I think over a period of time, the people will, as the track record builds, people will start moving to smart beta strategy and thematic category also, as and when they understand the dynamics of the product. So one very another one very repeated question which we get is, how do you differentiate between ETFs, index funds, and mutual funds? So we just kept one slide here. Both ETF and index funds does the same thing. It tracks the underlying benchmark, whatever the benchmark is, right? It tracks the total return of the benchmark, including the dividend. And mutual funds basically seeks to outperform, and hence it can underperform also. But the differentiation comes in terms of especially cost. ETF is comparatively lower cost than an index funds, but index fund is then a lower cost than the mutual funds. And if you compare all three, ETFs has comparatively a lower cost. In case of ETF, you can buy intraday depending on the market movement. In case of index funds and mutual funds, you can only buy at a day close NAV, and only ETF trades on exchange, and DMAT is required if you want to basically own a ETF unit. No, so what are the uses of ETF? Is it simply having a market exposure or exposure to a particular segment? Is it only, let's say, buying Nifty 50 or a bank ETF and simply getting that returns? No, it is now globally used for lot other things. So first of all, it is used, as I said, to take a very focused exposure in any theme you are very keen on. So one of the very interesting theme which is growing globally is ESG. which invest in the securities which are sustainable, compliant, corporate governance compliant, environmental and social compliant. So all those ESG is growing a lot. Let's say electric vehicles, biotechnology, all those things are happening. So if you want to take a focus exposure, that you do it through ETF. You can do a long-term tactical call. For example, you can own an ETF till, let's say, 5, 10, 15 years and get that long-term exposure. Or you can do a short-term tactical call also, right? Banks fell so much in March that one very strong tactical call was to buy a bank ETF and take exposure in that only select sector of index or stocks. So both long-term allocation and short-term tactical calls, let's say in case of oil, in case of banks, all those things are being done now. So it's not simply just a long-term exposure. In fact, S&P 500 ETF is one of the most liquid security in US, right? It's not a stock, it's an ETF. And also core and satellite portfolio approach. So either you can, let's say, if your core portfolio is a large cap, you can make it by investing in Nifty 50 or Nifty Next 50. Your satellite portfolio can be mutual funds or stock holdings, or otherwise you can maybe use large cap mutual funds to build your core portfolio. And if you want to take additional exposure in IT or bank, that can be done by ETFs. So since ETFs are so sorts of frugal in nature that it addresses various different needs, right? So that is why you can basically pick and choose and create a portfolio which is basically needed as per your risk and return profile, which you typically don't get in case of mutual fund. Because for example, right now, if you are investing in a mid cap, you'll also see large cap companies in it, right? If you're investing in a large cap mutual fund, 20% of allocation will still be there in a mid cap or a small cap segment also. Unlike in ETF, where you know the methodology and you know what you are getting into, and it will be only completely will be faithful to that methodology and portfolio. Now, also one additional very strong usage is timing the market, and that's what I'm talking about, tactical allocation or a short-term allocation. This is a graph from March till May end of Nifty 50, and this is the intraday movement. There have been 29 instances, almost 50% of time, where Nifty 50 gave more than 1% higher returns than the day's low. So what we are talking about here is that intraday you had opportunities to enter into the market at a lower level. In fact, if one day, if you remember, the market hit the lower circuit and it closed higher than the previous day's close, right? In case of ETF, you had the opportunity to enter at 8%, 9% lower levels and generate that alpha within that day itself. But if you would have bought a mutual fund, you would have got a NAV which is typically, let's say, 6% higher than the previous day close. So in ETF, based on market timings, you can generate additional alpha. And when the markets are more volatile, at times ETF makes more sense because you have more opportunity to generate, take these tactical calls and do these short-term trades also. So now we have talked about mutual funds and ETFs. In terms of returns, if you can just see what it is. So center one is the market index return. Let's say it's Nifty 50, right? On the right one, ETF will give you exact same return as market index return. On the left hand side, a fund manager is trying to beat the market index return, and it may generate alpha, right, over a period of time because of his expertise. But what happens? What can happen? An underperformance can happen, which can result it giving you lower returns than market index, and also the cost of fund, which is higher than the ETF. Typically, let's say 2.2% on an average for a large cap fund, right? A regular plan. So not only he has to outperform the market index by an average of 2.2% to give you exact same return, but then also additionally generate alpha so that you are getting some returns additionally for the risk you are taking by investing in his fund. In case of ETF, the cost is very minimal. It's just 0.07% in our case, in case of Nifty 50. And then it has an alpha generation possibility, which I just mentioned, that you can time the market intraday and get some additional alpha in case of volatility. So, and but that is specific to how much skill the investor has and whether he can generate this alpha or not. So that was about ETF. I'll now talk about what Mirae Asset is doing and why we are so bullish on exchange traded funds. So I don't think a lot of people will know, but we are present in almost 9 countries. We own lot of ETF specialized companies in countries like US, in Canada, in Australia, in Korea, Japan, etc. And for example, in global, there's a company called Global X which we own in US. It has almost AUM of almost $11 billion. We own Horizons in Canada, we own Beta Shares in Australia. So totally we are managing around 370 ETFs globally with an AUM of almost $38 billion, and we are the 18th largest player globally. I think where we differentiate ourselves from a lot of ETF providers is that we are a very niche players. I talked about marijuana ETF being the first cannabis based ETF which was launched by Horizons. We have, for example, uranium based ETF. We have artificial intelligence and robotics ETF, which has a aim of more than $1 billion in US. We have inverse and leverage ETF on India, which is there in Korea. It is not in India because it is not allowed by SEBI in India. Where what happens is, depending on the market movement, in case of leverage ETF, you get 2 times the return. If market has moved up by 1%, you get 2x returns. In case of inverse, it is more of a bear call ETF. If market has moved up by 1%, you get a -1% return, and if market has moved down by 1%, you get a positive 1% return. Right. So all those sort of very niche and innovative ETFs, and that is what we have expertise in globally, and that is what something we also want to replicate in India going forward. But right now we have entered into ETF space in November 2018. It's almost 18 to 19 months since we have launched our first ETF, which is Mirae Asset Nifty 50, and we have actually launched a second offering this year itself, which is Mirae Asset Nifty Next 50. As I mentioned initially in the call, Nifty 50 is top 50 large cap stocks, and next 50 is the remaining 50 large cap stocks out of Nifty 100. And the expense ratio is just 7 basis point in case of Nifty 50 and 14 basis point in case of Nifty Next 50, and both trades on NSE and BSE. So one of the reason why we did is obviously that in India, ETFs are still getting popular. It doesn't make sense to enter directly with an exotic product. So right now we have entered with the 2 plain vanilla products, and I'll come to what our product pipeline is. But actually Nifty Next 50 and Nifty 50 itself makes a lot of sense for investors right now. Basically, this table charts out what sort of exposure a large cap funds has in terms of sector wise, and what Nifty has and what Nifty Next 50 has. Now the observations is very stark. A lot of large cap funds have become benchmark hugging, right? Market has become so polarized in recent year that performance is typically driven by a very select few stocks, which is happening in case of Nifty 50 also. So all these large cap mutual funds are typically holding same set of stocks as their top holdings and invested in same sectors, and it's there in the data, like banks 24% in Nifty 50, 22% in all the large cap funds. If you go to consumer durables, softwares, petroleum products, you'll find a similar pattern in case of top sector holdings, right? So Nifty 50, why it makes sense? You are getting a similar exposure, a large cap exposure at a much lower cost. And as we discussed earlier, performance wise, it is beating almost 83, 84% of the mutual funds on a 3-year basis, right? Why does Nifty Next 50 make sense? Because it gives you a very alternate exposure. Just look at the sector difference between a large cap fund, a Nifty 50 and a Nifty Next 50. Banks are just 2.6%, unlike Nifty 50 and large cap funds where it is predominantly into banking. Consumer durable is 21%, almost a double. Then come finance, which is basically your insurance companies, and pharmaceuticals at 16.7%. So in case of Nifty 50, you are getting a very different exposure to the market. So what we are also suggesting is that if your core portfolio is created of a large cap fund or a Nifty 50, it's very good to diversify your holdings somewhat by investing in Nifty Next 50, because it is giving you a bit of a different exposure within that large cap space also, which is obviously comparatively more stable than a mid cap and a small cap. And this obviously uh, uh, comes out in case of rolling returns also. So for example, I'll just talk about 3-year investment horizon, because uh, we obviously suggest to do a longer investment in equity. On an average, with a 3-year investment horizon, Nifty Next 50 gave you a return of 16%, 16.7% last 5 years, compared to 11.5% by Nifty 50. Though recently Nifty 50, as we all know, has given much higher returns. It is at 9% compared to 5% of Nifty Next 50. So both are very compelling product on a long-term duration. Also, if you compare it to mid caps, and if you, as we compared earlier with a mutual fund, they give you a very decent returns. And for a long-term horizon also, I think Nifty Next 50 makes a lot of sense, because you are getting a different exposure. But if you want to form a core portfolio of large cap stocks consisting of blue chip companies, then Nifty 50 is the way to go. Just I'm like rolling returns for 5 years, 7 years is fine, but people are more concerned about what is happening recently. Kya hua hai? What is happening recently? So what we have done is March 23rd was the market lows. We tracked 3 months data, and we have created this table after 3 months. June 23rd ending. Now let's see how things have stacked up. Right in the bull run, everyone knew that Nifty 50 performed very well when the markets were high till Jan. But what is happening when the market recovered? So in last 3 months, when the market has recovered till June 23rd, Nifty 50 gave you a return of 37.8%. And just see the median returns of large cap funds. It is 33.5%. So you are seeing an alpha of almost 4% by Nifty 50 index in just 3 months. Compare it with Nifty Next 50, and I think Nifty Next 50 gave you a better performance because this, as I said, it has a lot of exposure to pharmaceutical stocks and consumer good companies. It outperformed the large cap funds by more than 7 to 8%. And this is the recent history if we are talking about that. So both Nifty 50 and Next 50 gave you better returns even in recent recovery than a median of a large cap fund category. And similar sort of performance you can see in a 5-year period also, when Nifty 50 gave you a better return obviously than a large cap fund median, and a 7-year period also when Nifty Next 50 gave you almost 14% return, which is almost 3% more than what a large cap fund on a median wise gave. So what are the I mean like we are a bit late entrant in the ETF market. So what are our advantages, right? There are so many Nifty 50 ETFs. So why Mirae assets? One of the so since we have a lot of global expertise, we manage so many ETFs globally. What we have done is we have created a very robust backend. What it does is, on the exchange, when you're trading in Mirae Asset Nifty 50 ETFs, the spreads are lowest in the market, and we track the index movement best in the market. And I think it can be seen in the kind of tracking which we did in March, when the markets were so volatile that our correlation with the market movement was almost 1. So if markets went down by 2%, our ETF went down by 2%, market went up by 4%, our ETF went up by 4%. So not only we have the lowest spread on the exchange in case of buying or selling. Just think like imagine a bank where you are buying a dollar or selling a dollar. They charge a spread for creating that liquidity. Typically, same sort of stuff happens in case of ETF also. But we being Mirae, we are basically offering this at a very low spread so that the impact cost on the customer is is very low. And this we are doing, as I mentioned, with continuous liquidity, where where someone we have appointed creates the market, ensure that the pricing is around always around the real time nav, and hence our ETF tracks the market movement the best, if you compare it to the remaining exchange traded funds in Nifty 50 and Nifty 50 category. So overall, our cost to own Mirae Asset Nifty 50 ETF is the lowest if you consider the TER also, and the spread on the exchange also. And also now we have a dedicated ETF team, which basically caters to all queries and expedites all the process which is related to ETF. As I said, we have a Nifty 50 and Next 50 ETF right now, but as we said that we proud ourselves being a niche player globally. So we have filed with SEBI on a ESG sector leaders ETF. So that is already done. So that will be the first product in India which will invest in large cap companies who who are doing very well on environmental, social, and corporate governance parameter. Right, corporate governance have become so important these days, and we only invest in large cap companies who are doing well in E, S, and corporate governance parameters. Also, we have filed for a fund of fund which will basically invest in underlying ETFs so that you're getting a passive exposure, but we will basically take in-house call which underlying ETF you should own, and that again will be available at a lower cost and invest in just ETFs. Also, we plan to introduce more foreign-based ETFs in Indian markets very soon. I mean, to conclude, finally, where we see ETF market head now, I think AUM wise, it's very simple. The only way is up, right? Government is also investing in more spreads are more products are coming in picture. But what is more important is that I think product spread will increase. You will start seeing more and more foreign ETFs in India also based on US market, based on emerging markets and developed markets. You'll also start to see more sector-based ETFs, more theme-based ETF in India now. And what is already happened will happen more is that the increasing retail participation, because a lot of what has happened till now is that focus had been on the institutional, but now focus has shifted a lot to the retail participation. And since now, let's say GPL is also hosting a seminar on ETF, shows how much serious they are also on ETF. So I think this will also encourage a lot of retail participation going forward, and the volumes will increase. One very interesting thing which has already started to happen in India is model portfolios. People are starting to use, let's say, combination of GSEC ETF, a large cap ETF, and gold to create a model portfolio depending on the risk appetite of an investor. So it's very simple, and people are already doing that. There are a lot of model portfolios. I think that will actually grow very popular in India, because if you can also mix, let's say, a foreign ETF, you are basically catering to all, in a way, all the asset classes slowly by slowly, and providing a very simple solution to the investors. Also, I think and one very interesting development which we are seeing is institutional investors are also starting to take tactical calls, right? They're using ETFs at their satellite portfolio. Let's say, as I mentioned, that bank ETF went down, banking index went down by so much when the market corrected. A lot of people invested at that levels, right? So a lot of institutional investors are taking those tactical calls to invest in ETFs. So it is just not a core satellite game. It's also a strategic allocation towards ETF and a tactical call, tactical investments in ETF, which is growing more and more popular in India. So I think future is bright for India. If you have a PF, you are already in a way exposed to ETF markets, but do check out the ETF products which are there in the market. Do check out, in fact, Mirae Asset Nifty 50 and Next 50 ETF, and I think as more awareness grow about ETFs, we'll see hopefully see more participation from the retail audience. So that's it from me. I hope this was helpful, uh, and thank you so much for listening.
Thank you so much for this insightful presentation, sir. We now start the discussion with our speaker and our moderator, after which we will put the other questions on the floor. I now hand it over to Mr. Pushkaraj Kanatkar.
Thank you, Siddharth. It was a very interesting presentation that you have kind of made, and a lot of eye-opening facts. Like you said, that it is the second biggest disruption after the smartphones in the last decade. And it certainly, and I would rather say that it has actually kind of outperformed even the social media platforms. That's what the data is showing us. So going forward, like what we expect in case of social media platforms as well, do you expect that the ETF as a product would certainly keep on outperforming the social media platform as well, in the sense that the growth in terms of an equity investor would be multi-bagger in that sense?
So I think a very good question. So I'll just state two numbers here, and this has again come from an independent party. So iShares, which is owned by BlackRock, they estimate that by in next 4 years this will grow to $12 trillion. There was a recent study by Bank of America which said that by 2030 it will be a $50 trillion industry. I know numbers are huge, but if you are globally talking about it right now, there's no stopping ETFs. In fact, US regulations are now allowing active ETFs, where you basically have to just showcase your investments on a daily basis, and you can take active calls also while you are managing ETFs. So all those interesting things are getting done. I think ESG, as I mentioned, will also drive ETFs a lot because you're using a third party expertise in identifying such companies. In India, definitely, I feel that adoption rate will increase a lot. We're already seeing that retail participation, thanks to Bharat Bond ETFs and CPSC and Bharat 22, have increased a lot. But as more awareness happens around ETF, and which is already happening, I think the adoption rate will increase in India also. Globally, it is already there.
Great to hear that. In fact, like the slide showed, that the AUM in India is around 23 million. Vis-a-vis even Latin American countries like Colombia have it at around 307 million. So I think the base effect in itself will give a big kick up. So certainly that is something which is interesting. Now, Siddharth, you have also kind of mentioned a lot of options that are coming through in ETFs across the globe. However, if we look at, let's say, the Indian ETFs, they are mostly kind of rounding around a limited number of instruments. So like a commodity ETF, we do have an exposure to something like a gold. But we have been talking to clients, and they would say that they would like to have exposure to something like a silver or crude oil, or maybe something like metals or base metals to that effect. Simultaneously, when it comes to equity sectors, we are seeing it that this exposure is limited only to few sectors, like you mentioned, it is into banks or maybe something like a infra. But maybe other sectors which too are in a way big time great themes. It could be pharma, it could be healthcare. So how do you see the industry spanning out on these other options that are available across the globe?
Okay, I think that's a great question. I think so. Answer is not a single statement to that. It's a threefold answer. So basically, first one is it's a chicken and egg situation, right? As I think in one of the slides you see that still ETF market in India is predominantly for Nifty 50, Sensex, and banking ETFs, right? And the market has is very concentrated. I think as ETF popularity grows in plain vanilla ETF, I think people will start demanding more and more theme based and strategy based ETFs, and that push from AMC will also start to happen. See, we have to be fair to these ETF providers also. There is, let's say, a low vol ETF, there's a quality ETF, there's the infrastructure ETF, dividend opportunities ETF, which track the companies which are giving good dividends. But the AUM or the traction in those products is still very low. So I think as and when the adoption rate increases, we'll see more products. Like we are the first one in India to who are going to introduce ESG based ETF. So it's a big call for us, right? So we also want to provide those products in the market, but then a pull also has to come with the push. Second thing is on the silver commodity side, I think regulator and government have been very supportive on the ETF market. They see it as a very big game changer, and that is why government is doing so many things to promote ETF, right? EPFO, pushing EPFO to invest in Nifty 50 and Sensex and all. But till now, for example, we are not allowed to invest, let's say, have an oil ETF or let's say only gold ETFs are being approved. So I think slowly regulator will also start allowing such exotic ETF as the market matures or as the backend of the ETF industry matures. So that will come with the regulatory approval, those sort of exotic ETFs. But apart from that, I think while there are only 88 products, but if you look at the spread, there's one ETF on Nifty 500, there's one ETF on, as I mentioned, dividend opportunities, one ETF on Sharia investments, and one ETF on infrastructure, consumption. So uh, in terms of product spreads, will slowly get there, but it has to be obviously both push and pull in case of having those product baskets.
Great. Now, generally, when we are talking of ETFs, like you mentioned, in commodities, the exposure is limited to gold. And in most cases, when we are kind of speaking with our clients, we come across a question that gold ETF, suppose I consider the rate in per gram, so it is quoting somewhere around a 4500 level or 4400 level, vis-a-vis the actual price in the markets, which is quoting at around 5000 or maybe something like a 4900 level or so. So maybe some kind of cost of fund is involved in a big way in the ETF as well. If I look at specifically the gold, as a competition to that, we now have what are known as sovereign gold bonds or the SGBs. So not just do they offer you appreciation in terms of the price, but they also give you a benefit of an interest rate of around 2.5% per annum, which means that it is an additional return for the end investor. So how do you kind of look at it with a perspective that how do you see competing with something like a sovereign gold bond?
So, so we don't have a gold ETF as of now, but I think you rightly mentioned that that particular product, sovereign gold, also makes a lot of sense. But if you see the inflows which have recently happened in gold ETF, it has been huge. People are investing and basically using the intraday market movements to invest in gold ETF. So I think gold ETFs is also there to stay if you want to have those uh, short term or a tactical call to invest in a different asset class when equities are not, let's say, not stable like it has been in last 4 months. But you rightly mentioned, right now there are a lot of avenues for investments and getting gold returns. But I think gold ETF is there to stay. In terms of what you mentioned on the pricing levels, it depends on a lot of things. Obviously, typically you see that expense ratio on gold ETF can be around 1%. So that will also eat into your returns. And also in terms of pricing levels, it is not, let's say, it depends at what denomination that particular gold ETF is present available in the market. So it depends on both the things.
Okay. Now, another important point, like you mentioned, that one could actually be trading ETF on an intraday scale as well. Now, timing is one part, but when you're looking at an investment avenue, or maybe you're looking at that asset with an investment horizon of, let's say, 1 or 3 or 5 years, then many a times, rather than timing the market, we recommend to our investors that they should be kind of putting it through SIPs.
Yeah.
We at Gepl actually allow our customers to kind of go through SIPs in the ETFs of Nifty as well as for gold, and so that they can in a way do a cost averaging of the prices. So from whatever inputs that you have, do you feel this actually strategy should ideally work out well, like a person putting in fixed sum every month through the ETF route into the markets, and therefore in a way kind of gauging it through?
I think it's a very good question. So I think SIP investment is the best method of investment that is there. I think you cannot time the market consistently. Having a very consistent, disciplined investment through SIP is the best thing you can have. I also invest in Nifty 50 ETF through SIP mode also. Now, what I was mentioning, so that is the obviously the most important thing. But what I was obviously mentioned that in case of ETFs, you also have an opportunity to invest at the market levels if you desire. So I'll explain it to an example that some of the clients or other not retail investors, but a larger let's say institutional clients or a large family or something, they have these levels at which they will enter into the market and exit the market, and those sort of levels you can only basically time it when you're investing in ETF, right? If you are very gung ho on Nifty 50, if it touches 9,500, you do it instantaneously at as soon as it touches that. In case of ETF, if you wait for mutual, let's say if you're doing it through mutual fund, you don't know where the market is closing. If you want to exit out of at 10,500, then you sell it as soon as it hit that. And a lot of people did that when the markets were very volatile, as you remember in March, especially, right? Markets were going I mean, going down like anything, and then there was some recovery seen at the close. So typically at those time, people time the market, and that is what one behavior we have been seeing in case of ETFs. But these are the investors who are very experienced and who track market levels and invest and exit at those levels. But in terms of long-term investments and SIPs are obviously the best mode to invest in ETFs or mutual funds also.
Yeah. And one last question that I would like to put forth is the concern that generally people have in India is regarding the liquidity that the ETFs offered.
Yes.
To some extent, you have kind of answered that through market makers, you are kind of providing the liquidity at least to Mirae asset investors. So how do you really see it kind of going through? I mean, maybe because the base effect is low, market making to that extent could be a bit, I would say, stable. But when it gets to a higher level, that market making opportunities or maybe kind of providing the liquidity through market makers would kind of be difficult, or you feel that it is more or less a systemic process and it would certainly kind of carry through even when the AUMs are pretty high?
I think, thank you for asking that question. I think it gives me the opportunity to talk about our expertise more. So what we have done is basically our market maker is our own sister concern, which is Mirae Asset Capital Markets. And they do the market making for us on the exchange and do it with a very fine spread. And how they do it is that they hold a very large quantum of our ETF in their portfolio, in their basket, and are able to provide any sort of liquidity between few thousand, few lakhs, few CRs on the exchange at a single price with almost no spread actually, or a very minimal spread. What we have also done, just for the clients, is if you go to Mirae Asset website, you can see the real-time net asset value of our ETFs on our website, which is refreshed every 5 seconds. So not only client knows what is the right price, but on the exchange, since our own sister concern is doing the market making, he can simply check that and do a very transparent buy or sell of our ETF. So that is how at least we have managed. But yeah, you are right on that thing that if I look at other ETFs, I think EP infrastructure has to grow more in India. More sophistication needs to be there. I think, especially in the month of March, and I specifically mentioned March because our correlation was best because we have an in-house AP. A lot of big ETF providers actually struggle to provide that liquidity on the exchange. In fact, one of the top ETF provider actually gave a positive return when the market was down. So the reason is it can only be accomplished by having a very good market maker who aligns these pricing as and when there is a basically a deviation between the INAV and the pricing on the exchange. So, and with that sophistication, basically the AUM will start mattering less and less. And obviously, the second part is as the retail participation increases, which is there in case of some ETFs, you will see that apart from market makers, people are also there who will start putting codes to make the price as close to the NAV, right? Because once there are so many participation, if people see that it is below NAV, they will buy. If it is above NAV, they will sell, and that is how the pricing will be set right. So I think with retail participation increases, the pricing will obviously be taken care of, but AP infrastructure is also important for the right pricing on the exchange, which thankfully we have focused a lot on.
Great. That's very informative, Siddharth, and thank you very much for all the answers that you have kind of put through. I'll now put you across to Forum, who will take us through with the remainder of the session.
Sure. Thank you so much.
Thank you, Pushkarat sir. Thank you for this fruitful discussion. We now move to the question and answer round. If anybody has any questions, can raise your hands, can ask it to our moderator and speaker directly. Also, since we took a poll at the beginning of the session, I'm sharing the results with the poll.
In the meantime, I have just received a question that whether Mirae offers any ETF ATM which in a way gives exposure in international markets and which person can invest in.
So answer is no right now, but we are in fact working on it. So very soon you'll hopefully see a product in India which is providing exposure to you to foreign markets.
Thank you.
So there's one question coming in. What is the difference between ETF and Bs?
Okay, so Bs is just a brand name. So Bs stand for Benchmark, which was the first ETF provider in India, and they named their Nifty ETF as Nifty Bs, Nifty Next 50 as Junior Bs. So it's just a basically a brand name which is associated with an ETF provider.
Thank you so much, sir.
It's the same actually. ETF and a Bs is same. Bs is just a name given to an ETF by an ETF provider.
Thank you, sir. The next question is, ESG is a great concept of some of the funds are paying off well. So it will be good to see the innovative ETF.
Yeah, I think that's the hope. So again, not trying to throw number, but globally, if we look, there's a $30 trillion mandate on just ESG based investing. That is all throughout, for mutual funds, for real estate, for stock investing, for anything, right? Corporate governance has become so important in a lot of these countries, right? We are facing so many corporate governance issues. And apart from it, millennials especially are focusing so much on companies which are doing sustainable development, having less impact on environment, doing good socially. So that is why ESG has grown so well globally, and that is why we are very bullish on the product we are introducing in the India market, which will be first of its kind in the passive space.
Thank you, sir. The next question is, what is the exit load of ETF, if any?
So there is no exit load on ETF, and that is why it is such a good uh, trading security or a tool also, because there is no exit load, unlike mutual funds.
Thank you, sir. The next question is, what kind of returns the GSEC ETFs are generating, if in case you can share?
So for GSEC, right now there are very few GSEC ETF, and I think you need to check that. So there is one based on 10-year gilt and another based on a portfolio of 8 to 11 or 8 to 13 years by few of the index providers. And as with a gilt product, you basically get the clean price returns also, as well as the accrual also. So it typically tracks the return of the GSEC. So, and right now you only have exposure towards a longer duration, 10-year gilt only.
Thank you, sir. The next question is, can you tell us how Mirae Asset ETF performed from Feb 20 till date compared to the peers?
So, okay, basically, see, in terms of performance, ETF, there won't be much difference between ETFs, right? If you're talking about a NAV movement, all the 17 ETFs which are there in the market let's say 17 Nifty 50 ETF are tracking Nifty 50 index, right? So if Nifty 50 index gave a, let's say, 11% return, all the ETFs will be, let's say, around about 10.9%, 10.995%, round about that, because that's the sacrosanct objective of any ETF. What you should focus on if you are investing through exchange is what sort of liquidity and at what sort of spread it is there on the exchange, and what is the expense ratio of those ETFs. Because in case of plain vanilla ETFs, the performance will, for all the products, is roundabout same.
Thank you, sir. The next question is, what is the suggested allocation to a moderate portfolio to ETF as an exposure?
So I think in case of a moderate portfolio, it totally depends on your risk profile. I think a combination of right now Nifty 50, Next 50, gold makes a lot of sense. And there are model portfolios which are available, and you can simply look at the returns which you have, and whatever portfolio which you have. Depending on that, you can create a portfolio with at least Nifty 50, Nifty Next 50, gold, and then have that basket.
Thank you, sir. The next question is, how much should be the exposure into ETF and active funds?
In active funds.
Yes, active funds.
So I don't actually. I'm not sure whether that question, because active funds typically do not invest in ETFs. There are few fund of funds which invest in ETFs, but a standalone simple mutual fund does not usually take exposure in ETF. They invest in the underlying stock based on a manager philosophy. So, for example, if I quickly summarize, a large cap mutual fund will invest 80% of its corpus in top 100 stocks, in whichever fashion the fund managers think is right, and remaining 20% across equity universe. A Nifty 50 ETF will only invest in 50 stocks in the same proportion which is there in the underlying index.
Thank you so much, sir. The next question is, in India, do you suggest theme-based or sectorial-based? Which one would be good?
Uh, so again, as I mentioned, it totally depends on your investment appetite. For example, banking ETF makes a lot of sense if you are bullish on banking sector itself. There is now an IT based ETF also. So it depends on the call which you want to take. But all these products, especially bank, at times make a lot of sense if they are available at the right prices, at right levels. In case of themes, I think the spread itself is pretty low, but there's a Nasdaq 100 ETF also. I'm not sure at what spread they are trading right now, but if they are available at the right prices, tracking index well, then US market exposure can also be taken through a Nasdaq 100 ETF.
Thank you so much, sir. The next question coming in is, how will an ETF fund manager allocate corpus in 50 stocks with an example? Will he invest equally in all 50 stocks, or he will invest more in better performing companies to increase returns?
No, so I think entire presentation tried to address that. Uh, uh, a particular ETF will mirror the portfolio of the underlying index. If I'm talking about a very simple plain vanilla ETF, in case of Nifty 50, it will invest only in 50 stocks and in the same proportion as it is present in a Nifty 50 index. So right now, let's say Reliance is 12.25%. I have to invest 12.25% in Reliance to get the same performance. So I'll always do that. If you, let's say if NSE builds one more index and there already is, which is Nifty 50 equal weight, where all 50 stocks are equally weighted, and I launch a ETF based on that index, then I'll be investing 2% again in only in that 50 stocks. So I have to be very faithful to the index I'm tracking. I have to invest in same set of securities in the same weightages.
Thank you, sir. Since we've received an overwhelming response, we've tried out as much as possible to cater to our questions. If in case you all have liked today's session, request you all to put on your cameras and give us a thumbs up so that we can take a nice picture. Thank you so much, everyone. We once again thank our speaker and moderator for joining us today. We also thank Mr. Chirag Shah from Mirae for making this session possible. Chirag sir, please can you wave us your hand? Can we see you, Chirag sir? I guess there's some, Chirag sir is having some connectivity issue. Okay, we've put in the feedback form in our chat room here. Request you all to give us your valuable feedbacks. For all the audiences who have joined us, thank you so much. We really do hope that we have clarified all your doubts. Hope you all enjoyed the session. We at Gepl Capital will come up with more such sessions related to different subjects. Thank you for joining us, Siddharth sir. Thank you for joining us, Pushkarat sir. Have a good day. Hope you all enjoyed the session.
Thank you so much for having me here.
Thank you so much, sir.